Appreciate you taking this opportunity to join us today. Learn a little bit about tax planning and philanthropy. I'm Rory Dollinghouse, the Senior Director of Planned Giving at the University of Dayton. And before we get started, a couple of housekeeping notes to share. First, this session will be recorded and available to view later on UD Digital. And during the panel discussion, we invite you to type in the chat where you are joining us from, and if you are an alum. Feel free to let us know the year you graduated in your major if you like. In the chat feature, select all panelists and attendees to share with everybody if you'd like to do that. There will be an opportunity at the end of the discussion today, about 45 minutes in, for questions and answers. So as questions come up, please feel free to type them in the Q&A tab on the bottom of your screen. We had a couple of questions that were submitted in advance of today's meeting, so we'll try to address those questions as well. So thank you very much for joining us here today and taking this opportunity to get together. Now, I'd like to introduce my colleague, Mr. Matt Borden, who will introduce our panelists and lead today's discussion. Matt?
All right, thanks, Rory. And as Rory mentioned, my name is Matt Borden. I'm the Director of Planned Giving for the University of Dayton. And so excited to join you here today, and so excited to introduce this really extraordinarily talented and credentialed panel of alumni and friends of the University of Dayton who practice in estate planning and financial planning and in charitable planning. Really excited for the discussion today, and really excited to learn myself a lot about some different ways of what I should be on the lookout for estate and financial planning in the future, and even ways to support UD. So first, to quickly introduce the entire, in no particular order, first up is Sean Nicholson, Certified Financial Planner. Sean is the Managing Director for Wealth Management at UBS Financial Services. He holds an MA from The Ohio State University and a bachelor's degree from Bowling Green State University. He is a former board member of WDPR, is active in the Bach Society, and past trustee and treasurer of Culture Works. He and his wife, Susan, have 2 daughters and live in Beaver Creek. Welcome, Sean. Next up is Paula Peck. She is a certified financial planner. Paula is a 1980 UD grad, a dual major in finance and economics. She earned her Master's of Arts in Economics in 1991 and became a certified financial planner in 1984. She has been in the wealth management industry for nearly 40 years and started with a fee-only financial planning and investment management firm in Cleveland, and then started her own firm in 2002 in Independence, Ohio. Both of Paula's children are UD grads, and in total there are 13 Flyers in the family, so a whole baker's dozen. So welcome, Paula. We appreciate you being here today. Next up, Corey Allen. He is a 2003 graduate of UD, and he has completed his Series 7 and Series 66 security registrations, and also holds life and health insurance licenses. In 2017, he completed the Certified Wealth Strategy Program, and in 2020 completed the Accredited Investment Fiduciary Program. He and his wife, Amanda, have 2 kids that live in Kettering. So welcome, Corey. Next up, Greg Palmer. Greg is a retired partner from the law firm of McDermott, Will & Emery, and was based in this firm's Chicago office. He assisted major international companies in tax planning and tax controversy matters. And Greg is also a CPA. Greg graduated with a BS summa cum laude from UD in 1978 and holds a law degree from the University of Chicago. He is also a member of UD's Leo Meyer Society. So thanks for being here today, Greg. We really appreciate it. And finally, John Clow. John is an attorney with the law firm of Pickrell, Schaefer, and Ebling. He holds his bachelor's degree from Siena College, and he is a University of Dayton Law School alum from 1994. He also has his LLM in tax from Capital University. He focuses his practice on estate planning, trust, and probate law. He's a fellow with the American College of Trust and Estate Council and is a OSBA certified specialist in estate planning. So welcome, John. So again, just the bios alone say how credentialed this panel is today. And again, very excited to get discussing this, and we have a lot to cover. So we'll just go ahead and jump right in. So first off is let's maybe talk about what has happened in the last 12 to 18 months, because a lot has happened in the last 12 to 18 months. And I think the big thing that we're thinking about is the coronavirus, because that has affected just about every aspect of life. And well, estate planning and financial planning are included in that. And in fact, in October 2020, LegalZoom found that 32% of people had made revisions to their estate plans, or at least drafted a new one since the start of the coronavirus pandemic. And in addition to all of that, some individuals were motivated to look at their financial plans, their estate plans, their charitable plans because of the presidential election. And so I'm going to invite John and Sean to start us off and see if maybe you could share, have you noticed an uptick in your clients drafting or revising their financial plans, their estate plans, their charitable plans? And if so, have you noticed any trends about what your clients ultimately decide to do? What are those trends? So Sean, John, you want to share?
I don't mind jumping in first. And I have noticed, clients are really interested in talking. They want to discuss not only what happened last year and what they can do in the future, but a lot of them have at that time, revisited what their charitable intents are. We have always been really active with charitable giving, especially in the last few years with required minimum distributions. People find that an excellent way to give money, and I think it's going to grow as a huge potential for the University of Dayton and all their alumni to be able to give access to this money from retirement plans. It's fully taxable, not only while they're living, but to name the university as a beneficiary for their charitable gifts. There's huge amounts of money sitting in retirement plans right now that are both in IRAs, 401ks, etc. And you don't even have to redo your will or your trust to make the university a beneficiary of this. You can simply change the beneficiary of your IRA or 401k to include the university, and the university can even specially designate that money to where you want it to go. I'll give you an example of something I was just noticing, and I hadn't looked at it until recently. When I checked on the University of Dayton's most recent website of where they want money to flow, I noticed a fund there that's now available called the Student Crisis Fund. And the Student Crisis Fund was established a few years ago to keep students from having financial problems when times of crisis happen. It's an unanticipated emergency where they might have problems for a serious illness or an unforeseen financial condition. So I'm going to start telling my clients about that particular fund, because I don't think they know about it. And I think it would be something that they would have a real interest in supporting. And I could easily see them wanting to make a beneficiary change to support that activity. Also, in the last year and a half, we've seen an unprecedented move in stocks. I have a lot of clients now who have highly appreciated positions, not only in their IRAs, but outside their IRAs in stocks that have gone way up, especially the technology stocks. And those people probably need to rebalance their portfolios. So by taking and giving some of these appreciated stock to the university, of course, you can do that and get a tax deduction for the donation. The university can sell the stock then at no commission and no tax, and they can designate it for where you want to go. If you want it to go to a scholarship, great. If you want it to go to athletics, great. If you want it to go to this student crisis fund, that's great. So I think if anything today, we just want to get people thinking, hey, there's some real needs out there. The university has a lot of great programs that we need to support. And the easiest way to do that, and the most tax favored way to do that, is through the use of these required minimum distributions and appreciated stocks. And the university is well set up to do that. I've worked with them many years, and they make it very easy. I'm going to switch it over to John now and let him discuss a little bit too.
Yeah, thanks, Sean. I actually did see quite a bit of increase in planning for estate and charitable last year. I'd say in the beginning it was mostly estate, which would make sense. You know, it was during a global pandemic and people were home, stuck in their house with a lot of time on their hands. But I think as the year progressed, I saw an increase in charitable planning also, which would make sense, as Sean mentioned, the increase in the stock market. And I'm also a proponent of use of retirement accounts, as Sean mentioned. The only other thing I've started noticing here recently is an uptick in the interest in gifting real estate. And I think that trend will likely continue. I mean, obviously, if you're reading the papers at all, you're seeing the increase in value in real estate prices around the country. That may be something that continues, and that may turn into more charitable gifts for real estate as we continue.
So very, very interesting in terms of some of the increases that you've seen. And it sounds like some clients have increased their philanthropy as a result of looking at their estate plans. And so, you know, John and Sean, just a quick follow-up question on that. For those individuals who have increased their charitable giving or included charity now as part of their will, have you generally encouraged them to share those plans with the charity, especially if it's going to be a deferred gift, or, you know, John, in your case, you know, if they're looking at exploring real estate, you know, have you encouraged them to work with the charities as part of all of that planning?
I'll go first, one, if you don't mind. Yes, I always encourage them. I will tell you quite honestly, some clients, and for whatever reason it is, they don't like to, they feel like they're not quite ready to commit, or they don't necessarily want their name out there yet. I'd say about half of them are open to going directly to the charity and letting them know about it, and some just are reluctant to do so.
Yeah, I think that's true. I've actually had a number of clients who have supported the University of Dayton, but they've actually done it through the Dayton Foundation, where they can support multiple charities, the university being one of them. And so I don't know that the university always knows that it's directed that way, although we do encourage them to do that. I think they kind of like the anonymous feature of the putting it in the foundation and giving it to various charities. But I do think that more and more we need to be out there discussing the idea of going directly to the charities like the university and getting some people out there talking about it. I mean, I can understand a person wanting to remain anonymous, but I think there's something very good about somebody stepping up and saying, I made this gift, I'm going to support this function of the university, and I want other alumni to know that I did that, so that maybe they will get inspired by doing the same thing.
Those are great thoughts. Thank you. And so as we're thinking about what's happened over the last 12 to 18 months, you know, the coronavirus is a big portion of it, but one thing that also happened was, even before the pandemic struck, Congress passed the Secure Act in January of 2020, and that affected a lot in terms of retirement accounts. And you know, some of the more impactful changes in terms of what we're talking about today include the elimination of the stretch IRA for non-spouses. The Secure Act also increased the required minimum distribution, where it once was 70.5. Now people have to start taking the required minimum distribution at age 72. And so I'd like to invite Paula and Sean. So in this area, are there any strategies that you've talked about with your clients and maybe something that the attendees today should be aware of, especially if they're charitably inclined?
I'll take it first. Actually, I've had quite a few meetings. What's happened is the Secure Act has really put the IRA in play more than it's ever been before. It used to be the non-spouse recipients, beneficiaries, where have this great benefit of having a long-term lifetime income stretch, and that's gone now. So a lot of planning really needs to be done in terms of what do you do now? And going to being able to use the benefit of, for example, the University of Dayton's plan giving department, the idea of using something like a charitable remainder trust. What you can do rather than having the ability to just get, if you're, for example, you're not the primary beneficiary is not the spouse, but instead the primary beneficiary is instead a non-spouse or the children. And what you can do is when you look at how the children can get their income, if you were to name, for example, the participant were to name, for example, the University of Dayton as the beneficiary, they could create a CRT in which a payment plan, instead of being 10 years, could be 20 years. And there's variations, there's CRUTs, there's CRATs in terms of, percentage of income or fixed income. But what I think you could do, for example, working with Matt, is have the ability to really talk about that, talk about how those things would play out, and look into how you could take advantage of being able to use two things. One, being able to stretch out an income, and also being able to have a charitable donation. We can talk about this later on, but there's a lot of play right now, or a lot of opportunities in terms of proposed planning in the estate planning area. So having a deduction to a charity is a fantastic way to be able to use your IRA.
And I will also mention that I think it's overlooked, but I think a lot of people should consider, if they want to do charitable gifts, think about using those right now and then doing some IRA conversions into Roths so that you can maximize the tax efficiency on down the line. If we believe that tax rates might be higher a few years down the line, it might be good to have more in your Roth. So by making charitable gifts right now in larger amounts, you can use that to offset the tax of the conversion from a traditional IRA to a Roth, and make it much more tax efficient for your family and your heirs a few years down the line.
I actually did that last year.
And so we have a perfect case study. So thanks, Greg, for that. And thanks, Paula and Sean, for that really great perspective. And so we've covered what has happened over the past 12 to 18 months. And so perhaps we put a new lens on our conversation now, and maybe look at what's going to happen over the next 12 to 18 months. What should we be thinking about? And one of the biggest areas I think that is on a lot of people's minds right now is the stock market, because in March 2020, I think we're all fairly aware that the stock market plunged. And since that bottoming out has done a lot of recovering. And in fact, in the past few weeks, the S&P 500, the NASDAQ Dow, they've all hit record highs at one point or another. And what that means is there might be a lot of people who are listening today who have highly appreciated securities, and if they were to sell them, they'd be subject to a lot of tax. And so Corey and Sean, maybe you can join the discussion and share, for those people who have really highly appreciated securities, are there any things that they should be thinking about? Might there be a way that they can buy low and sell high here, or give high here?
I'll let Corey go first on this one.
Sure. One of the strategies, I've had conversations, Paul had mentioned this before, the use of charitable remainder trusts. But one strategy that's I would say it's probably talked about even less than a charitable remainder trust. A version of it, something called a NIM CRUT. And my clients tend to be a little bit younger, still employed, and so conversations I've had are with clients, that may have appreciated stock in their brokerage accounts, but also, for example, in a non-qualified stock option plan, for example, where they may have some appreciated stock in there. But it's a strategy that allows you to do charitable and kind work, but also not necessarily have to take income immediately through the management of what you hold in there. So for folks that may have a longer time horizon, there are strategies in there that say, that allow you to use some of those charitable strategies to your advantage for future income, but also kind of combining something Sean mentioned earlier, which is a big one, is kind of combining multiple strategies, which is incorporating these charitable trust strategies, but also combining that with Roth conversions and really maximizing what's in the tax code currently. I know we're going to talk about AGI changes and what that means in more detail a little bit later, but there's some big advantages there with short windows to take advantage of.
The other thing I was going to mention is I think people, if they really evaluate their portfolios, they're going to find that they probably need to do some rebalancing and some reallocation. I mean, in a big run-up like we've just had, there's a lot of people who have portfolios that are out of balance. They probably ought to reduce some of their stock exposure, maybe look at other types of stocks. And if you do that, you're going to pay some tax. But why not consider the appreciated securities you have and say, okay, I'm going to tithe 10% of my appreciated gain to the University of Dayton. And that 10% I tithe to the University of Dayton is going to offset a lot of the tax for me to rebalance my portfolio and put it back into where it should be. Maybe I should have more fixed income in there. Maybe I should have some more dividend paying stocks. Maybe I should reduce my technology exposure that's run up. And so think about and look very closely at the university's programs that they have and where you can really make a difference through your gifting and impact, and open those discussions with the development department, and then consider, okay, once a year I'm going to rebalance my portfolio, take the appreciation securities and tithe 10% to a specific program at the university. It'll make you feel good, it'll help your portfolio, and it'll save you some taxes.
Great, thanks for that, Sean. And it's interesting you mentioned that because, one of my curious follow-up questions was for perhaps a donor who has dividend-paying stocks. So let's say they bought low and that they have a dividend-paying stock that's paying maybe 1% yield quarterly. Are there any strategies that are available that include a charitable component where they can maybe even increase their cash flow with those? Any thoughts there, Corey and Sean?
Go ahead, Corey.
Yeah, and again, you're getting into some details here, but getting into some strategies around how these charitable planning works, getting into the fact they have some income requirements in there, right, that may be greater than what you're getting through your dividend, but can be offset by some of the tax advantages that Sean was mentioning before. I think the big thing in there is to understand that there are rules in place that if you're charitably inclined and you get educated on those strategies, they incentivize certain behaviors, right? If you're going to you have the desire to make impact and support the social good in general. In this course, obviously, we'd love to see that happen at the university. The IRS has some incentives to do that, right? They want to incentivize those behaviors with private capital, and getting educated in those strategies can benefit you personally, right? A lot of times I think we talk about philanthropy and giving. The idea is, well, I have to give away some of my financial security to achieve that. Well, that's not necessarily always true, right? There's a lot of variable involved with each individual. But there are strategies if surround yourself with good advisors like those on the panel, that you can, if that's your end game and you want to make some impact with your personal capital while maintaining your financial security, you can certainly do that. So it's not just this idea that, well, I have to give things away and reduce that. Not necessarily, right? There are strategies around trusts and how those income vehicles work, and tax incentives to do that can give you stronger situations in other areas by using multiple strategies.
Matt, were you thinking of something like a grantor retained annuity trust?
Like, was that directed at Matt, Greg?
Yeah, maybe I'll just suggest that as an idea is you could make a donation of your appreciated stock to the university in the form of a trust where you retain an annuity and increase rather than having 1% dividend yield. You could have a higher yield in terms of the annuity that you retain, generate a current deduction, as well as benefit the university with the contribution that's made. So you increase your current annual income, get a tax deduction, make a charitable contribution to benefit the university, and that's a way to boost that current income stream.
Well, there's no question. A lot of people out there are looking for yield. There's a lot of people out there still sitting with hundreds of thousands of dollars sitting in no interest bearing bank accounts right now. And they were used to getting 4 or 5% interest off that money to live on. You know, why not take a $100,000 CD that's not yielding anything? You can give it to the university, claim 100% deduction right now, and have a 4 or 5% yield. So now you're, instead of getting 0 on that fixed income portion of your portfolio, the university is going to pay you $4,000 or $5,000 on that deposit. You get a big tax deduction, and you get to do something really good with it when it's over for whatever department you want to give it to.
Okay, I'm going to jump back in here. It looks like Matt is having some technical difficulties, and hopefully he'll be able to join us here in a moment. But in the meantime, let me help us move on to question number 4. Congress has responded to the pandemic in 2020 by adopting the CARES Act and reauthorizing some of those provisions for 2021. The most notable changes include the 100% adjusted gross income deduction for cash gifts to charity, and some changes to requirements around retirement accounts. And these changes are expected to sunset at the end of this year. So are there any strategies that you have suggested to your clients to think about in this area?
Well, and that's one reason I had mentioned if you have cash sitting in the bank, this year you can get 100% deduction on that contribution, and that may sunset at the end of this year. This is a great year to really seriously think about that. Make that cash donation to the university. If you need income, they'll come up with a strategy to provide income back to you. If you don't need the income and you're sitting fine financially, just make that donation, get 100% deduction, and do something good with it right now. Okay, there are plenty of scholarships, there are plenty of good departments that need this money that can really manufacture wonderful new programs on your donation. Look around and find out what's the needs are, and you'll be surprised that there's some really good things that can really make you feel good from these donations. And now, if you're ever going to step up and make a larger cash donation, this is the year to think about that.
One of the things in there I would add is understanding what AGI kind of means. For example, you say, well, let's take the same idea. You have a $100,000 gift you can make. You also have an adjusted gross income of $100,000, right? So that means you're going to get 100% deduction against your income, or you could also use that $100,000 as a deduction to offset another transaction. For example, we were talking about real estate earlier. Let's say you own some rental property that you were thinking about liquidating. Well, you get a $100,000 deduction against the capital gains against liquidating some property that's appreciated as well, which you don't have to pay tax on to offset that. Or a Roth conversion. Say you have the $100,000 gift, you have $100,000 against your income, but let's say you could convert, say your effective tax rate is 20%. Well, in theory, that would say, well, then I could take $500,000 of IRA money, convert it to a Roth, and not have any taxes realized in doing that, and have a tax-free asset at that point of $500,000 because I gave a gift to the university, either directly or into a charitable vehicle, a trust, anything like that. So this 100% AGI, Sean was mentioning, opens the door to really make it, not only just make an impact to something you're passionate about, and hopefully something with the university. I'll put a plug in for the Flyer Promise program, by the way. You should look into that. It's a personal favorite of mine. But also drastically change your personal financial situation and financial security and strength at the same time, which is could open the door for future giving that you hadn't really thought about. And so I advise, I urge anybody listening to this to seek out this conversation with an advisor you trust to see exactly what opportunities exist, because they're significant.
Great. Thanks, everybody. And I am back. Sorry about that, internet problems. There is no greater fear in life than when everybody freezes in the middle of a webinar. So with that, we'll move on. So we've talked about what happened in the last 12 to 18 months, maybe what we should be looking forward to in the next 12 to 18 months. And so now let's kind of switch to that final lens. And what should we be looking at 18 months and beyond? So we're looking at 22 and beyond. What are some things that we should be thinking about, and what are some things that maybe you've been telling your clients? And so one of the things I think is most forward and front and center right now is in the area of tax. So there are several proposals on the table right now. They include raising the capital gains tax rate. They include increasing the top bracket to 39.8%, decreasing the estate tax threshold. And so Greg and Paula, it'd be great to have you here, offer some of your perspective. So what are some of the things that we should be thinking about here in terms of the tax proposals? What are some ideas that maybe we can think about to mitigate the impact of any of them if they gain some traction and are passed by Congress and signed by the president? So maybe, Greg, do you want to kick this off?
Sure. Well, we already talked about donating appreciated property, and this is really sort of doubling down on the potential benefits from doing that. So take, for example, if you have highly appreciated stock, and let's put aside income brackets and level of estate sizes, because some of these things have various proposed cutoffs as to where they come into effect. But two dramatic changes are nearly doubling the capital gains rate, also increasing the top income tax rate, and then doing away to a large degree with the step up in basis at the date of death for appreciated property. And so all of that makes donating appreciated property a much more tax efficient way to approach addressing the charitable contributions that you would like to make, as well as your own tax and financial planning. There's one other important change that they're proposing with respect to real estate and like-kind exchanges. And although that's a little more esoteric and dealing with real estate, people who invested in real estate frequently dealt with transitioning their portfolio of properties by taking advantage of Section 1031 and doing like-kind exchanges. And that is likely to go away if the Biden tax proposals go through. And so if you have appreciated real estate, aside from appreciated stock, which we've already talked about, it might be worthwhile to consider making a donation of that. That's a little more complicated for the university, but I'm sure it'd be happy to have the donation and to deal with those complications as part of a program to work with folks.
In a situation that we're looking at with this proposals, what I've seen is it's really, as a financial planner, an opportunity really to take a long look at where you stand. At this point with these proposals, it's trying to outguess the guessers. Who knows what will finally stick, but the reality is it's time to really, it's a good time to start planning. Some of the big changes that I've really recognized and really are going to have a significant impact, I think, on a lot of clients is both a proposal to do away with the stepped up basis, which means what used to happen, or currently happens anyway, is that once someone passes away, if there's appreciated stock, let's say, for example, we had Apple and the basis is $3 and now it's 127, all of that gain goes away at the estate, and whoever receives the stock gets basically the stock at 127. The proposal is that you would lose the stepped up basis, and so all of that gain now goes to the next the recipient. So there's definitely an opportunity when it comes to what to do with capital gains in that situation. And again, it's outguessing the guesser. No one knows what can happen, but it's definitely an opportunity now to say, okay, I've got this stock, I've got a lot of gain. What's the best use for it? You could set up something like a CRT. You could set up a grantor annuity and have an income stream, but do away with that tax liability, both in your own estate or in your children or whoever's going to receive it. The other thing that's really, I think, a big deal is the proposed change in the state tax exemption. Currently, it's 11.7 million. We've got a few clients that have taken advantage over the years, and they have used up at this point up to about 5 million worth of their state exemption, which currently what happens with the state tax laws is it sunsets in 2025. And so we would drop from 11.7 down to about 5 million, somewhere in that range. Proposal now is to drop it possibly down to 3.5 million. So now you've got a situation, for example, that I'm currently looking at is what do? You can't gift because everything you gift is going to be, or family anyway, is going to be taxed at a 45% tax bracket or up. And so again, an opportunity would be to consider something along the lines of a charitable remainder or charitable gift at some point, especially a charitable remainder, because it gives you two things. It gives you the ability to retain some kind of income. And in addition to that, it also allows the charity to, the estate anyway, to have a charitable deduction. One idea also is to consider using the IRA as a way to take advantage of both the payout, as I mentioned earlier, about being able to expand a donation from 10 years, or a recipient beneficiary getting a donation or an IRA distribution of 10 years instead of be 20 years. And then again, what you would get off the estate is you would get an estate tax deduction. So there's definitely opportunities, definitely a lot of great planning opportunities. And it's worth definitely at this point to visit with your financial advisor, attorney, a financial planner, and really sit down and work out opportunities. And I think, Matt and his group could, I think, help in terms of providing a way to consider different charitable gifting opportunities.
Great, thank you. And maybe one last quick question that we have before we kind of move into some wrap up and some questions from the audience is kind of looking at, in addition to taxes, the other area that Congress has been taking a little bit of a look at is retirement accounts. And so they have a few proposals on the table, including increasing the RMD age again, allowing for qualified charitable distributions to be used for life income gifts, and expanding qualified charitable distributions to other types of retirement accounts, not just IRAs. So should we be thinking any more frequently or less frequently about any of those proposals? Are there any strategies our audience members should be thinking about if any of those kind of gain traction and move forward with this Congress? Greg, Paul, what are your thoughts there?
Well, I definitely think that with the potential expansion of retirement accounts, traditionally we've just been limited to IRAs and contributions after you reach 70 and a half of up to $100,000 a year. And obviously many people have other types of retirement accounts. And so if they expand and liberalize those rules, that opens a whole new area that folks ought to sit down with their strategic advisors, as well as, again, with you, Rory or Matt, to talk about what the possibilities are. And obviously, if you can be making donations with pre-tax dollars out of those accounts, that's very advantageous as the rates continue to go up. And we already talked about the stretch IRAs and maybe a little bit of elaboration on that. What it was is effectively you could have your IRA paid out over the lifetimes of your children or whatever, and now it's your spouse's life plus 10 years. And so again, if you can make charitable contributions with those pre-tax dollars out of IRAs or other types of tax deferred accounts, and do that under more liberal rules, I think that should be a priority. And touching or tying it back to something that Paula said earlier, those accounts are part of your estate. And so as the exemptions will decrease, even if it's just under the sunset provisions, that's a dramatic increase from for two spouses, something approaching $24 million, dropping down to something approaching $13 million. And under the Biden proposals, maybe it's more like $6 million. Well, think about all of your assets, whether it's appreciated stock that you hold directly, whether it's what you have in your retirement accounts, whether it's appreciated real estate that you have, all of those come into play with regard to the potential tax changes.
One of the other things to consider doing, as well as what I've been doing with a number of my clients, is to sit down and break out their net worth. Oftentimes one client or another, the husband and wife, might have a much larger level of their net worth compared to the two of them. And as you go through that, using the opportunity of being able to allocate your assets between the husband or the wife, being able to change up how the balance is, gives you an opportunity to take advantage of whatever you can as it relates to the exemption. The other thing that I don't know that we've talked much about, but regarding the use of an IRA and charity is how simple it can really be. I know with Schwab, TD Ameritrade, probably a lot of them, these are the groups I use, you have the ability to literally get a check writing capability. And so long as you have cash in the account, you can write checks straight out of your IRA. And with some growing restraints, if you will, or constraints on the IRA, it might be a great opportunity to take advantage of writing your your charitable contributions, not from personal accounts, checking account, but instead from your IRA. So it's a great opportunity to be able to take advantage of the qualified charitable deduction or distribution and just use it straight out of your IRA. And it's a check writing. It's as simple as writing a check. It's really pretty easy. So
there's also the ability to use donor advised funds, which isn't quite as convenient as writing a check, but you could make a large contribution again if you need to offset, for example, a Roth conversion, or if you're trying to just to lump together charitable contributions in order to exceed the itemized deduction, the standard itemized deduction that you have. You can put money into a donor advised fund, or if you're contributing directly to the University of Dayton, rather than doing smaller amounts over a period of years during each year, you might want to make one larger contribution to get yourself over the standard deduction that's available and get a larger tax benefit that way.
Great, thanks for your perspective. And so kind of as a quick wrap up, we're interested to hear kind of from each of you, and if there is one thing that our audience members should walk away with from this discussion thinking about, what is it? So I'll ask that of every one of our panelists, and maybe Sean, if you want to start us off.
Yeah, one thing that we didn't discuss, but I find a lot, I'll bet many of your alumni, those people listening and those people not, have become financially well off. And they're probably sitting right now with old life insurance policies that have outlived their usefulness. A lot of them might own non-qualified annuities that have built up a lot of taxable gains. I would encourage you to think about donating those old life insurance policies or those old annuities that you're probably not going to use, and donate them right now and get a tax benefit right now, and put that money to use instead of just continuing to accumulate more assets, and feel good about doing something with this money. Find something at the university you can make an impact that moves your heart, and really find something that you can do to make you feel good right now.
Great, thank you. John, what's that one takeaway that you would suggest?
Yeah, so my advice would be to keep in mind that planning really is a process. People sometimes think about it as just flipping a switch or just putting some documents in place. And as we have these changes in both potentially in the estate tax and the income tax, you really may have to think about this as a longer process. It's something you start a little bit earlier in life and something you kind of guide all the way through, as opposed to waiting till we're all 70 years old and then putting something in place. So I think it's a good idea to get educated, stay in touch with your advisors, and think about it as a process.
Great, thank you. Paula, what's that one takeaway that we need to be thinking about today?
Well, I think this past year has brought to light a couple of things. One, our mortality. And while I know everyone knows that there's an end at some point, a lot of people just sort of put that on the side. And I think what happened last year with this coronavirus is that people, A, had time to think about it because they didn't have to commute back and forth to work, or they were laid off. And so it gave them an opportunity to really think about what they were doing and where things were at. And I think with that also brings to light, you know, your charitable intent. And I think that there are so many planning opportunities coming up, you know, more so than ever before with the changes, proposed changes in the tax laws, that I think it's an opportunity to give you just, you can only outguess the guessers, or it's the only way you can look at it. But what you can do is at least try and take advantage of the what ifs and be ready just in the event something happens with any tax law. So.
Great. Greg, what's your parting piece of advice, or what should we be thinking about?
Well, over many years, I saw clients want to avoid dealing with this subject because you hate to think about your own mortality. As Paula said, COVID did a great job of reminding us of our own mortality. And this doesn't take place overnight in terms of what you do. It takes a fair amount of time to wrap your head around what your planning ought to be. There are lots of different choices to make. It takes your advisors time to run numbers and react to those questions and thoughts that you have. And then it takes time for your advisors to rework your documents. And you know, embracing UD as a part of that plan and coordinating with UD. And I understand some people's desire for privacy, but I strongly embrace the idea of telling UD if that's part of your plan and coordinating with you and Rory and others there as to how that's going to, how you're going to approach it. So it's really, you know, basically now's a good time to get off our chairs and start working on it, because it takes time, and we know that we're all mortal.
And great, thank you, Greg. And finally, Corey, what are your thoughts? What's that one thing we should be walking away with today?
I think it's appropriate this is coming through the university because, you know, knowledge is power, you know, obviously. And if you take some time to think about what you care about, right? Because, you know, this old adage is the risk of being a little crude that you never see a hearse pulling a U-Haul, right? And so at some point, you know, we talk a lot in financial planning about, you know, indexes and rates of return, but at the end of the day, money's a tool, and think about the impact you want to make with it. I mean, obviously we want to take care of ourselves and our family, but, you know, it's not going to go with you at the end of the day. And so I urge you to really think about things that get you excited and things that you'd like to see it, would like to make an impact on, and then learn the rules. There are rules around there that work to your advantage to help you do those things. So seek out those advisors who can help you do that, so you can feel good about not only what you've achieved professionally in your life, but also how you've spent it and where it went. And both while you're alive and afterwards. And I would urge everybody to really invest time into that idea and that thought process.
Great. And thank you all for those pieces of advice and kind of those tidbits that we should be walking away with today. And so with that in mind, we'll move on to audience questions. And so participants had the opportunity to ask a question beforehand. We had 2 submitted from our participants. So we'll ask that, and then we'll ask Rory to look at the chat and see if there's any questions for the panelists. And so I'll go ahead with the first of the 2 questions. And Corey, this one I think is best for you to take. And the person asked, they have an Ohio deferred compensation account, and they have to take a minimum distribution each year because of their age. And their question is it possible for them to assign the minimum distribution that they have to take to avoid taxation, but still keep the account in their name? What are your thoughts there? What should they be thinking about?
Sure. Well, we've talked a little bit about qualified charitable distributions. Unfortunately, Ohio deferred comp, and I'm going to assume here, which I probably shouldn't do, but only 457s, which fall into that in Ohio, have required distributions. But qualified charitable distributions can only come from IRAs at this point. So I would work with your current advisor or someone to go through the details of that, because my thought is to execute a charitable distribution from that type of account, you're going to have to do it from an IRA. But if I'm right about that, again, that's an if that's correct, you should be able to move that into an IRA and that not be a taxable event. And then you will be able to do that, just like Paula was talking about, send it directly from your IRA to a charity that you care about and keep it off the top line of your taxable income.
Great, thank you. So maybe some things to explore for the individual who asked that question, and explore it with their advisor. And so our second question, Paul, I think this one might be something that you can provide some perspective for. And so the participant asked us to discuss a scenario in which a primary beneficiary of an IRA is able to redesignate and pass the funds to a charitable organization listed as secondary beneficiary. So what are some things to maybe think about or to ask or explore there?
Well, just to be clear, I'm not an attorney, but I think one of the things that could be considered in terms of that situation is to disclaim. It's possible that if you're the beneficiary directly and you don't want to take it, it's possible that you might be able to take a disclaimer and send it off to the charitable, if it's a charity. The alternative would be to have the multiple beneficiaries, and one of them, for example, be the charitable intent. So there's an opportunity there. There's a few different laws or rules, actually, it just came up through, I think, the Secure Act now, that kind of change the equation in terms of how that's split up and who comes first. But definitely worth spending some time with your state planning attorney, financial planner, your financial advisor to discuss this. So.
Great, thank you. And with that, Rory, is there anything in the chat?
Yes, we've got a couple of questions. The first one being, can an RMD be given to a foundation with directions to distribute to the donor's designated charities when you have UD among other charities?
I think I might know the answer to that one. Right now, I don't think charitable checking accounts, which I think is what the person's referring to, where you can make a deposit into like the Dayton Foundation's charitable checking account from your retirement account, such as an RMD from your IRA. It has to go to a designated charity. It can't go to a charitable checking account and then be distributed out to multiple charities, as far as I know.
Okay, anybody else want to comment on that one?
I think I understand the question. If the donation is being made based on the RMD requirement, basically the qualified charitable distribution offsets that. So whatever your number is, say for example, you're required to take out $10,000 from your IRA this year, you can write a check up to that amount, or checks actually in that amount to basically offset your RMD. So if you have, again, if I understand this question correctly, if you have choices in terms of where you would like the money to go, you could, again, going back to having check writing on an IRA, you could write checks to any one of those charitable intents that you have, whether it's this or that. And certainly if it's working with the University of Dayton, I would imagine you have the capability of requesting that they move the money from one place to the other, if that's what you want.
Okay, thank you both. next question, and Matt, this one might be directed towards you and I a little bit. The question is UD proactive in approaching wealth investment professionals that are associated with the university to encourage them to guide potential investors to leave UD in their estate plan?
Well, geez, all of a sudden I'm a panelist now, so multiple roles, multiple hats. We certainly provide information to advisors, and we think that there are very strong partnerships, and we always want to have those partnerships so that somebody has a lens of philanthropic impact when they're thinking about making a gift to UD. That said, it's a very personal decision, and one in which it's a personal discussion between them and their advisors about what they ultimately decide to do. And so we would certainly always welcome that type of support, but I think that I would just classify it as a partnership rather than, and the decision really lying on the donor. What are your thoughts there, Rory?
Yes, I agree with you. The university is trying to build a big network of alumni for a whole bunch of reasons, only one of which is fundraising and financial planning and philanthropy. But all the values that come out of having a strong alumni network, helping young graduates get jobs, all those types of things. So working together in seminars, webinars like this one, panels, discussions, bringing education to the community, all of those things are important. And certainly working with financial advisors who deal with clients who may have an interest philanthropically in the university. We want to make sure we're working with those financial advisors and estate attorneys so that they know everything they need to know about UD, so that if they have a client that wants to support the university, we can help them do that.
And Rory, I'll say something to that, just kind of speak to that a little more directly to the way I think the question's asking is, I've been on the Planned Giving Advisory Council now for, I don't know, 6 years or so, maybe a little longer than that. And if the question is almost like, is UD ever soliciting advisors to go talk to clients to raise money as an extension of development? I would say that has never happened ever. Has anybody ever said, hey, I want you to go talk to your clients about giving to the university? It's been more, they've asked, hey, can you help us understand some of these strategies? So when, alumni come to us, we can talk about it. That's the way that relationship has always worked. Mm-hmm. So I just want to make sure it's clear. It's like the answer is the university soliciting advisors to talk to their clients? No, that has not happened in my experience ever.
Yeah, thank you, Corey. Appreciate that explanation. We have one other question in the chat, but it is a question that's more direct towards the asker's personal situation. So I'd rather not address that here on the call. We can follow up with that person after the call. So we have a minute or two here left. If there are any other questions or other comments, if any of the alums or friends of the university that have other questions, feel free to put those in the chat or in the Q&A.
I'd like to add one quick plug for something that I mentioned on during our prep call. When people were thinking about their estate plans and talking to their fellow UD alum about their fond feelings towards UD, in addition to, of course, current gifts and specific bequests that you might have as part of your estate plan, one other thing to consider is in most well-written estate plans, there's a failsafe provision that says, well, if all of the people who I would be leaving money to have somehow met an unfortunate demise earlier than anticipated, where does the money go? And typically what you include is a charity under those circumstances. And so in addition, again, to current gifts and specific bequests that you might make as part of your estate plan, that sort of fail-safe clause, if you've got fond feelings about the University of Dayton, that's a perfect place to also include the university.
Well said, Greg. Thank you. With that, I'd like to thank all the panelists for taking the time today and before in preparation for this event. I'd also like to thank all of the folks in the audience for attending. I hope you found this time valuable. And of course, you can follow up with Matt and I if you have any other questions. A couple of other things. I'd like to invite you to join some upcoming digital events. There's a webinar May 27th at 6 p.m. called From Farm to Flyers. It's about UD's beginning. Another webinar on Wednesday, June 9th at 12:30. This one's really interesting. We have a unique opportunity to have a conversation with 3 UD presidents. So current President Eric Spina and former Presidents Dan Curran and Brother Ray Fitz. We will be following up with everybody with an email shortly after this event today and a survey. And we would appreciate any and all feedback that you can give us about this session. And with that, I thank all the panelists. I thank all of our guests today, and really appreciate everybody's commitment to the university and the time that you've given. And I'll end it by saying, go Flyers.